Hey everyone, welcome back to Corporate Decoder. Future FinTech Group Inc. FTFT just filed an 8K announcing a new funding deal, and I am seeing a familiar pattern that investors need to watch closely. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is bringing in cash through a kind of lending where they get money up front, but it comes with a high cost that we need to break down. Alright, let's dive into what Future FinTech Group Incorporated is doing. They've entered into what is called a Pre-Paid Securities Purchase Agreement, or SPA for short, with a group called Avondale Capital. Think of this like a pre-arranged deal for receiving money in stages. The shareholders already approved this back in September of 2025, so it is not entirely new territory for them. It is a way for the company to access up to $10 million through these prepaid purchase instruments. So how does this work in practice? In the first part of this deal, called Prepaid Purchase Number 1, Future FinTech got $800,000 in cash. But here is the catch: they issued a prepaid instrument with a face value or principal amount of $884,000. This means that for every dollar they received, they essentially promised to pay back more later. This is the core of a prepaid deal like this. They've done this before. In September of 2025, they did a similar deal, Prepaid Purchase Number 2. They received $1 million in cash, and in return they issued a prepaid instrument with a principal amount of $1,080,000. Again, they are effectively paying a premium to get cash now. This is a way for companies, especially those that might have trouble accessing traditional loans, to get funds, but it is usually more expensive. Now, the big news in this filing is Prepaid Purchase Number 3, which happened on May 20, 2026. Under this latest agreement, Future FinTech received $2 million in cash. And what did they issue in return? A prepaid instrument with a principal amount of $2,160,000. This means there is an 8% original issue discount, or ID, of $160,000. This discount is already baked into that higher principal amount. It is essentially a fee they pay up front, and it is non-refundable. So to get $2 million now, they've agreed to a future obligation that is $160,000 larger, and that is just the discount. Not any interest that might also apply later. This type of financing often comes with high interest rates or other costs that make it very expensive for the company in the long run. Looking at past funding rounds like the one in 2021 where they received $800,000 and issued an instrument worth $884,000. This pattern of paying a premium for immediate cash is consistent. Now, looking at the rest of the form, you see these boxes about whether this filing is meant to cover other types of communications. Future FinTech has checked off no for all of them, meaning this 8K is strictly about reporting this funding agreement and nothing else. This is standard procedure for a material event like a new financial agreement. This form is being filed under Section 13 or 15 of the Securities Exchange Act of 1934. This is the general requirement for public companies to report significant events to the Securities and Exchange Commission, or CC ensures that investors have access to timely information about what is happening with the companies they invest in. The company's common stock is registered and trades on the Nasdaq Capital Market under the ticker symbol FTFT. This means it meets Nasdaq's listing requirements. Although, as we know, smaller companies on Nasdaq can sometimes face challenges staying compliant. Future FinTech is not electing to be considered an emerging growth company. This means they will comply with all new or revised financial accounting standards without delay. This is a choice companies make based on their size and expected growth, and it indicates they are prepared to meet the same reporting standards as larger, more established companies. The main point here, as we've discussed, is the entry into a material definitive agreement. This is the section where the company officially reports on significant contracts or deals they've made. This funding arrangement clearly falls under that category because it involves a substantial amount of money and impacts the company's financial structure. Finally, under item 9.01, they list the exhibits attached to this report. The most important one here is Exhibit 10.1, which is the actual document detailing this Prepaid Purchase Number 3, dated May 2026. This is the primary source document for all the details of this transaction, and it is incorporated by reference into this report. They also have Exhibit 104, which is the cover page in an interactive data file format, making it easier for computers and software to read. The report is signed by Hu Li, the Chief Executive Officer, and dated May 26, 2026. This means the filing occurred 5 days after the actual agreement was made on May 20th. This is typical, allowing time for internal review and formal submission to the CC. So, looking at the bigger picture here, Future FinTech is a company with a market cap around $7 million and relatively few employees. They've recently announced a reverse stock split earlier in 2026, which is often done to boost the stock price and meet exchange listing requirements, but it doesn't fundamentally change the company's value. They've also been focused on building a global payment ecosystem and cooperating with other tech companies. However, this latest funding deal highlights a recurring theme. They are relying on more expensive forms of capital. While securing $2 million is a positive step for immediate needs, the structure of the prepaid purchase agreements with their built-in discounts and potentially high effective interest rates can lead to significant financial strain down the line. It is a classic case of trading future earnings and potentially diluting existing shareholders at a high cost to get cash now. For investors, the question is whether this short-term funding will translate into long-term growth and profitability, or if it is just kicking the can down the road with even greater financial obligations. The fact that they've engaged in multiple such prepaid purchases suggests it's a crucial, albeit costly, part of their funding strategy right now. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.